Hi, this is Chris Verhaegh, writer of the Pulse Options newsletter. I'd like to welcome each and every one of you to the webinar today. Thank you for taking time out of your busy day to come see me. Hopefully some of you aren't snowed in and have nothing else to do. Today's presentation is called Trading Weekly Options, using math to generate fantastic short-term trading profits. I think you all agree that the returns I'm going to show you are fantastic, and I think can't argue that they're short term. So having said that, let's get into the nuts and bolts of what we're trying to do. We're going to try and show you how to make money, right? Buy low, sell high. Webinar's over. Thanks. Have a good day. See you later. Now, seriously, there might be a little bit of oversimplification in what I'm about to share with you. I know a lot of you guys are going to ask questions, some very good questions. As a general rule, I'm not going to answer questions until the end. I've discovered that quite often you guys are thinking like me, and I'm going to have the answer in 1 or 2 slides away. So I tend to push off the questions to the end. Having said that, one thing I cannot push off is the disclaimer, right? This is actually just a short form disclaimer. All the securities used in this presentation are for educational purposes and are not to be construed as a recommendation to buy, sell, trade any of these securities. All right, now that we got that out of the way, again, I'm going to try and teach you as much as I can in as short a period of time as possible. I try and hold off the questions to the end. I trade stock. I'm sure a lot of you out there are stock traders. That's where we tend to come from. We watch television. We see them talking about stocks. Stocks are pretty one-dimensional. You buy them low, you sell them high. With the exception of collecting a dividend, the only way to make money is buy low, sell high. Now, theoretically, you can do it in a different order. You can sell high first, buy low later, but that has a lot of risk. Options, on the other hand, are multi-dimensional, right? Options take into consideration the price of a stock, the historic movement of the stock, the expected movement of the stock, right? The cost to carry, the interest rate, any dividend that the stock pays, and they just cost a fraction of what a stock does. And because of this, people tend to trade options for one of 2 reasons, right? How much do they use? Options options on Apple, $100 and some odd stock, can be pennies, dimes, quarters, or dollars, much less. And because an option does not have the same negative effect as a futures contract, where you get all this leverage, but you're leveraging your risk as well, you risk very little amount of money, right? So historically, the reason to trade options is, how much can you make and how much do you use and how much can you risk in the process of doing it. So historically, options have been directional plays. So first off, some of what I'm about to share for someone that's traded options for a while is going to be, considered a yeah, duh, I know that, yeah, duh, I know that. Get to some good stuff. I don't want to leave anybody behind, so I'm going to share some things that an option trader might find basic, but again, it's for the benefit of everybody, and it always helps to review. And also, I kind of have a different perspective on things, so it's also nice to get a different opinion. So there are 2 types of options. There's a call option and a put option. A call option gives the buyer of that option the right to buy the stock, right, without obligation to buy it. The right to buy at a set price for a set period of time. The set price is called a strike price. The set period of time is expiration. And so when you think about it, since a call option gives the buyer the right to buy a stock, right, a call option can be looked at like a bet a stock is going up in price. A put option gives the buyer the right to sell the stock at a set price for a set period of time without the obligation, right? And so a put option could be considered a bet is going down in price. Now, people will also buy put options as insurance on stock they own. So not in the case when you own a put option combined with owning the stock, you're not betting the stock's going down. You're ensuring that if it does go down, you'll be able to collect. There are 10, 12,000 stocks out there. It should not be anybody's goal to trade every stock in existence, right? The goal should be to make money. And the key, I believe, is to focus on the opportunities that have the least risk with the greatest opportunities. And so you want to reject all the bad opportunities, all the bad setups. And so you start with a large universe of opportunities and you whittle the list, keep whittling the list and trying to focus on a few, right? And so I have created a rejection system that allows us to focus on the best setups. I call this the pulse system. Now the pulse is an acrostic. Acrostic is an acronym on steroids, right? An acronym is basically just initials, but an acrostic is initials that spell something, right? And what it is, or how I look at it, it's a system to find the best setups, but I'm presenting it in a system to have you learn it the best. It's a memory crutch, a memory tool, an acrostic. So P stands for potential profit. U is upside reward. L is low risk. S is setups and strategies. E is events, entries, and exits. We've taken the pulse system. I've written a book, right? I've filmed videos. I write a weekly newsletter, right? In the weekly newsletter, one of the sections is called the watch list. And of the 10, 12,000 stocks out there, like 3,000 or 4,000 of them have options, and about 300 or 400 of those have weekly options, right? These are options that have an expiration every Friday. So of that 400, I run through a set of filters and I shrink it down, right? And my section in the newsletter, I list a watch list, and we always look at some moves from the previous week to show what you could have done, right, in an effort for you to learn what you can do. And this is sort of looking backwards, right? And you can't trade in the mirror, but you can learn that way. The next section on the newsletter is the top 5 plus or minus. These are 5 give or take stocks from the watch list that I have a specific reason to trade, and we write commentaries on them, right? And in each week we review my picks from the previous week. And this is where I say the emperor has no clothes, right? Because if I make a pick on Saturday, January 31st, and then come Saturday, February 7th, we're going to review how I did. Right? I can't hide from it. I don't want to hide from it. Next, education. We try and educate throughout the newsletter. Again, I try and use little tricks like an acrostic. I try and write anecdotal stories in such a way that you guys can learn it, that it becomes memorable. And I'm kind of proud of myself, and I base that on the success of my students. And we're going to see some of the success of my students and some of my examples coming up here. So before we look at individual success, I want to look at the letters that make up Pulse. P is potential profit. I guess I could have said profit potential. It's the same thing. So this is back in June. This is Amazon. These are call options. Again, these are bets that the stock is going up in price. On the left, I've put a highlight around the opening trade of the day. On the right is a highlight on the high of the day, right? And you can see that the $300 call opened at $8.50, went to $27.50. right? A little bit less expensive of an option, the 320 call opened at a dime and went to $8.95. Now, options control 100 shares per contract, so that 10-cent option was $10 a contract. That went to $895 a contract. I think you can agree that that is fantastic. And since this is in the same day, I think you can't argue that it's short term. A week later, Amazon moved down and its put options increased in price, right? Not as big a move as the calls, but still the examples I have here are averaging around 300 to 500% in one day. Again, I think it's fantastic returns, and I think you can't argue that it's short-term returns. Here we have two charts. The chart on the left is a VXX call option, right? It moved intraday from 8 cents to $1.90 before giving some back, right? Which brings up a very important point. Even though options give you the right to buy a stock at a set price, we're not buying options to exercise them. We're not looking to buy the option, exercise it, and then own the stock. We're looking to buy the option and sell the option, right? And so if the option sells off after we get out of it, it doesn't bother us so much. Again, we have in the lower right is a screenshot. This was taken from Yahoo. This showed an option that opened at 2 cents a contract and hit a high of $1.50. That's $2 becoming $150 in the same day. Now, we're going to start looking at some of my students' trades. And so I asked, is this a typical trade, right? And this was from a year ago. I had a student that bought the $155 call option on Tesla, right? This gave him the right to buy Tesla at $155 a share. He bought 20 contracts for 60 cents, and he sold them for $7.30. He put up $1,200. He pulled out $14,600. He made $13,400 gain, right? I asked questions, is this a typical trade? Now, I'm going to tell you, it's not an atypical trade. This is not a rarity, but it's maybe not so typical because he tied up so much money. Same student made this trade here, right? This was from a couple months earlier. This is FCX. This is Freeport McMoran. He bought an option for 4 cents and he sold it for 32 cents. $4 a contract, $32 a contract on the exit. This, I'm going to say, is more typical because my students have hit on FCX over and over and over again. FCX is not a rarity to us. This, backing up real quick, this was from November 7th of 2013. This next example is from November 7th, 2014. 1 year to the day, right? Here we had an option that went from 8 cents to 36 cents. Right? Not quite as good, but I think you guys can agree, if you can make 400% in 1 day, hopefully, hopefully you're not disappointed. Again, I'd like to think it's fantastic, and I think you can't argue that it is short term. This email, this is an unedited email from a student. I believe this is a more typical trade, and I'll show you why it's a more typical trade. First off, the student writes, great call on your updates. Right? He's referring to the fact that in my newsletter, I pick these stocks. Right? This is Chipotle Mexican Grill and FAS, which is the 3X bullish banking sector tracking stock. He says at 9:35 a.m. Eastern Time, I bought 10 Chipotle Mexican January week 4 $500 puts for $1.95, which is $195 a contract, times 10 contracts is $1,950. And by my amazing math skills, I figured out he paid $15.35 in commissions. He also bought 10 of the FAS January week 485 puts for 35 cents. Again, $35 a contract. 10 contracts is $350 and $15.35 in commissions. He says, as the attached screenshot shows, which will be the next slide, he closed out both transactions for a one-day net gain of $6,538.44. He says fantastic. I agree with him, and I think you can't argue that in one day it is not anything but short term. Now, I say that this is a typical trade because one of the things we try and teach you, right, when you trade options, right, there are some optimum times to buy them. One of the optimum times is shortly after the open, right? The stock market opens at 9:30 a.m. Eastern time. We like to let the market take a few minutes to settle in. He bought 5 minutes after the open, right? And on the screenshot here, you can see, and I don't know if there's a marker. That's one thing I probably should have found out, but hopefully you can see that he sold them at 15:56, which is 4 minutes before the close, right? He bought them 5 minutes after the open and sold them 4 minutes before the close. When you learn this system, when you understand how the stock market works and how options works, you can realize that you don't have to be stuck to the monitor all day if you know the sweet times of day to make trades. We like to look at the open and we like to look at the close. Again, this email, even though, 6,500 gain in one day, I think it's fairly typical. I get emails from students all the time. I got an email last week from a student who made $6,000 on FCX. I think those are typical, but what I think is very typical is the time of his trades, right? Again, what is typical? So I wanted to let you know that I traded Salesforce.com today, right? That was on your list. If my math is correct, I realized 500% on this trade. He said this was virtual trading. See attachments and make comments. I still have to watch 3 of the videos, right? The key here is he says this was virtual trading. This is part of the beauty of this system when you think about it. Since our gains are short term, we can know fairly soon whether the decision we made was the right decision or not. Imagine me being a stock market guru, and I get on the webinar here and I say, hey, in July of 2010, I predicted this stock would go up, and then in March of 2013 it was. Look at this other stock. In February of 2012, I predicted it would go up, and then in August of 14 it went up. See how good I am. Well, that's meaningless, because if I tell you something's a good deal today, you got to wait 1, 2, 3, 4 years to see if it's a good deal. What you find out here is that we will know in a very short period of time, not only is this working, but if it's working for you, right? And because of that, you can practice, you can paper trade, you can pretend like you're making the trade without risking money and see how you do. Build up your comfort level, build up your experience before you're risking real money. All right? Anyway, here's his example. He bought these at 16 cents. He sold them at 96 cents. 96 cents is 6 times 16 cents, but the difference if you subtract 16 from 96 is 80. And 80 is 5 times 16. So, I don't know, is his math right? Upside reward, right? P-U-L-S-E. Showing you the potential. You might say, hey, look, isn't U the same thing as P? Did you just conveniently use U to spell out the word pulse? Well, maybe I did, but here's the bottom line. I show you the big gains that are possible. Now we consciously eliminate stocks that we feel won't have options that have an ability to make a minimum of 100%. And the reason being, we will not be right 100% of the time. I think we're right far more than 50% of the time. But here's the bottom line. You can't risk more than you can pay, right? And so if we can look to make a minimum of twice our investment, whether we hit something for 2, 3, 4, 500%, or we hit something else for 5, 6, 7, 800%, 1,000, 2,000%, these are not unrealistic numbers, but we want to search for the minimum of 100%. And we want to not risk a lot of money while doing it, right? We don't look for options that are $10, $15, right? $1,000, $1,500 a contract. We like to look quite often for options that are under 25 cents. FCX, we consistently have been hitting on options around 10 cents. Right? 10 cents an option is $10 a contract. Again, I had a student sent me an email. He made $6,000 last week trading FCX options. He bought 125 contracts at 12 cents, $12 a contract. Put in $1,500, right? He was able to sell it and pull out $7,500. The beauty of this, what we're doing, low risk, he has been trading as my student long enough that he feels comfortable buying $1,500 worth of an option. But guess what? He could have put a fraction in, right? $12 was the minimum. $12, right? I like to think each and every one of you got $12 you can risk. PUL, right? That's the first part of the pulse. That's how we pull money from the market. Now I got to tell you, in my newsletter, I pick the stocks, right? I do it from my system. My system is not black box. I don't hide how I do it. I will teach you how I pick stocks, right? The key, right? I think once you've taken that big list of stocks and got it down to a manageable few, is to pick the specific stocks. And the specific stocks quite often are because of a setup, right? And we can have two types of stock setups. We can have a market-wide setup. Market-wide setup can become because of a non-farm payroll report, can become because of a Federal Reserve meeting. A stock-specific setup might be due to earnings. Now understand, we do not buy our options on stocks prior to the release of earnings because they're inflated. Again, we have a whole system on how to do it. This is more of an overview, and again, I'll try and save some time and answer questions. Again, there's two types of setup, stock specifics and market-wide, and then we have two basic core strategies. We have a directional strategy and a non-directional strategy. A directional would be buy a call because you think the stock's going up, right? Or buy a put because you think the stock's going down. Non-directional is where you buy both a call and put because you don't know which way it's going to go. You know it's going to make a big move. We do this with straddles and strangles. A straddle is a call and put with the same expiration and the same strike price. A straddle is a non-directional bet a stock will move. Right? When you buy a call and put, if the stock goes up, your call's going to make money, but your put's going to drop. You buy a call and a put and the stock goes down, your put's going to make money, but your call's going to drop. You basically want a bigger move than might be considered typical. Understand that a typical move, the way the market typically looks at stocks is what did it close at today compared to what it closed at yesterday, right? The market tends to compare one close from the next. When you look at a price of a stock trading during the day, it'll either be up or down. It's not up or down from where it traded 2 minutes ago. It's up or down from where it closed the day before. So if a stock opens at one price, moves way up, gives it all back, and ends up back where it was, right? A buy and sell, a buy and hold stock investor isn't going to make any money, but someone that bought an option had an opportunity to make a great profit. And if you don't know which way the stock can move, you consider buying both the call and put. Again, two ways of doing it are straddle and strangle. A strangle is a call and put, same expiration, but different strike prices. A strangle has a lower strike price put than the call. A strangle is going to cost less than a straddle, and it's got more upside, but you really want the stock to make a big breakout move with a strangle. P-U-L-S-E. E is events. Again, we have stock-specific events, market-wide events, I guess, stock-specific setups. Backtracking here, I'm trying to go so fast, I'm so excited. A stock-specific setup, a couple slides ago, could be a technical pattern, a chart reading, right? This is the event. This is the earnings event, the FOMC event. Forgive me, I get so excited. I don't know if anybody here's been at any live event that I've given or been at another webinar. I do get fairly excited about certain stuff, and I can jump ahead a bit. Now, E also stands for entry, right? Again, we can get in at a particular time, near the open, near the close, or we can get in when a stock's at a particular price, right? We like to buy our straddles if and when the stock is equal to the strike price. We have a mathematical advantage. E is our exits. Now, we can get out with a target. We can buy an option for a dime and set a target for $1, right? Or we can buy an option, have it go up in price, and then trail a stop underneath it and try and let it run. These are our basic two core exiting methodologies. Now, again, the newsletter, we have our top 5 plus or minus. Top 5 plus or minus literally is 5 give or take stocks that have a setup, right? A technical pattern that says, hey, look, this stock is more likely to move today than the options are pricing. It's a good deal to buy options, right? And so in the newsletter, in my top 5, I will take a stock and I will write commentary on it, whether I think a person should buy a call, whether they should buy a put, or whether they should buy both. And so this is a quote from a November newsletter a while ago. It said, if Tesla gaps up, right? This was in regards to Tesla's earnings. Again, we trade earnings, but only after the release, not before. So I said, if Tesla gaps up, I feel that the reversal has a higher likelihood of being the better trade, meaning if it gaps up, it's not going to hold. It's going to give it back. I said, if Tesla gaps down, well, then people are going to run away from it. So I said, the continuation of the down move has a better chance, right? Again, in the material that I present, my videos, my books, you know, in newsletters, a student that's been around a while has a much better understanding of what I'm talking about here. And it goes back to this concept. I teach mantras. I want people to remember certain things, right, over and over again. If you say the same thing over and over again, they'll remember it. One of the things I say is, obvious is a function of familiarity, right? When I write about stocks and setups and movements, I'm making you familiar with how the option moves in those instances. And patterns repeat. And whether you've traded it yourself with real money or not, you're gaining experience, right? You're gaining my decades of experience. You're gaining your own experience. It will become obvious to you, right? Because you're becoming familiar with it. It will be obvious what to do. Anyway, in this instance, I said, after the earnings release, buy puts on Tesla, right? And if you're not sure, buy a put and a call, right? Because you'll make so much money on the put, that's okay to lose something on the call. And in case I'm wrong, right, that means you'll be right. So a couple days later, I got an email from a student. He says, Thursday at 9:39 a.m., right after the open. He said, I bought 5 contracts of the $143 put on Tesla at 42 cents. Right, 42 cents a contract, $42 a contract, 5 contracts, $210. He says he placed an order to sell at $1.50 and he left. Right, he set a target. He was filled 2 minutes later. right? You suggested puts no matter where it opened and it worked. So here's a question. Is tripling your money fantastic? Because I think you cannot argue that 2 minutes is short term. Different student, same setup. As a newer student of 3 or 4 months, I had a great week trading your system. Bought one contract, right? Bought the minimum. He bought the November 149 put for $1.38, which is $138 a contract, and he sold it for $6. Again, the beauty, you don't have to put in huge amounts of money. The other important point is you can't kick yourself if you leave money on the table, right? We're pretty good at this. We find moves that are often 1,000 or 2,000%, and darn it, if we only get 300 or 400% of that move, right, 400 or 500% of the move, we cannot complain. We have to accept the fact that we can be sloppy in our trading. I say that because here's a chart of the guy that bought for 42 cents and sold at $1.50 2 minutes later, right? 2 days later, it hit over 10 bucks. His $42 a contract had become $1,000 a contract, right? He left some money on the table, but you know what? He's got 3 times the amount of money he started. The Pulse system, right? I've written a book, filmed a bunch of videos. Videos are kind of like this. I might go a little bit slower. I make sure I don't make any mistakes, right? You can watch them over and over and over again. I write a weekly newsletter. I've been writing this newsletter for years and years and years and years. I was first professionally published. I'm a writer, right? I was first professionally published almost 40 years ago when I wrote a logic puzzle I sold to Dell Crosswords. So I'm very analytical. I consider writing a craft. I work very hard at it. I've got a very good editor and a very good publisher. And the newsletter's got the watch list, the top 5. We constantly review and we're constantly educating. The whole goal is to teach you how to exploit a setup, right? I've mentioned FCX, options under a dime. I can't count how many emails I've gotten from students that have hit on FCX. One of the other stocks that's one of my favorites is Schlumberger. Schlumberger. If you read it, it looks like it's Schlumberger, right? Schlumberger is an oil service company. I've been trading this stock so long. Its ticker is SLB. We jokingly add a lowercase o and we call it SLOB. So I am a SLOB trader, right? My kid at career day at school, asked my son, so what does your dad do? Oh, he's a SLOB trader. He's like, oh, he doesn't dress very well? Hey, you know what? I trade Schlumberger. And here's why I trade Schlumberger. June 6th, D-Day, we had an option that moved overnight from 6 cents to 89 cents. That's 1,300% overnight. A couple weeks later, not quite as good, right? It opened, closed one night. Again, previous close, that's the closing price the day before. The open is the first trade of the day. Both of these were at 7 cents. It hit a high of 70 cents. That's 10 times as much. That's 1,000% move. A week still later, right? 33% from open to high. The overnight change was 2,900%. 2,900%. Right? That's a pretty good trade, by the way, 2,900%. Right? And we get these things real regularly. Here's an email I got on Schlumberger back in June. Thanks, Chris. I got into SLB early this morning and got out with a $1,000 profit in 15 minutes with 10 contracts. I enjoy your service very much. Too bad I'm not a day trader. Thanks again, TAK. So a couple of things, right? I don't know if you think $1,000 is fantastic, but I'd like you to think that you would think 15 minutes is short term. Again, This presentation is using math to generate fantastic short-term trading profits. Now, he bought these and sold these the same day in 15 minutes. Now, I have this email up because people ask me all the time, they say, hey, I don't have $25,000 in my account and therefore I cannot day trade. And my answer to them is twofold. One, right, the reason they say this is there's a regulation in the United States that if you're in a margin account, right, if you're in a margin account and you day trade more than 5 times in a week or 3 times in a 5-day period, whatever it is, I ignore the rule, that you are considered a day trader, and this is a bad thing. There's 2 things about this. Many of the examples I've showed you are buying in the morning and selling the same day, and so that is a trade in one day. It's an intraday trade. Many of the examples are showing you the close of one day, right? Buy them on a Thursday, sell them on a Friday. That is not a day trade. Doesn't matter. Here's the bottom line, though. This regulation is specifically for margin accounts. The federal government has done this because margin allows you to borrow money. But the rules do not allow you to borrow money to trade options, right? With stock, you can borrow money, you can pay your broker in 3 days. Options, you got to have the money right then and there. You cannot do them in a margin account. Therefore, a small account can open a non-margin account. It's called a cash account. They can put a couple $1,000 in it. They can make 10, 15, 20 day trades a day, 5 days a week, week in, week out, and they're not subject to the rule. So if you have a concern about it, again, you can have a non-margin account or you can hold overnight. Either one of those things. Bottom line, I believe you can build your account to where it's above 25,000 and then it becomes a moot point there. All right. Again, here's a overnight trade. Closed at $4, opened at $3, right, which is a 7.5 times gain, and then made a high of 435. This is not a day trade. Again, our buddy Verhaegh from October. Here's another one. Closed at a quarter, went to $2.80 at the open. Again, 1,100% at the open, and then it went even higher still. Here's another one. 16 cents at close, $2.24 at open. Right? If my math is right, I think that's about, what, 14 times? I don't know. Don't hold me on my math. Here's a sloppy slop slob story, right? Or sloppy slop. I try and make it fun, by the way. You know, whether it's fun for you or not, I want it to be fun for me. And again, I really hope it is fun for you. I've been a student of yours for 4 months now, and yesterday, Friday the 17th, I officially became a slob. I bought the 95 strike price puts at 14 cents and simultaneously set an order to sell at 56 cents. Right? That's the target order. Bought at 14. He's basically trying to sell them for 4 times his cost. He says he ran out to do some errands and get ready for a business webinar at noon. I peeked at my trading account, and my sell to close order had been filled for a 333% profit in less than 2.5 hours. He said with sloppy slop, it got up to around 90 cents and closed at 66 cents, right? He left a bunch of money on the table. All said and done, he's a very happy camper. Thanks for your training and very interesting newsletters. Again, I try and make it interesting. He says, I only wish the business webinar was nearly as interesting and informative. I see a couple of you guys are asking questions. Again, I'm going to answer all your questions at the end, so don't worry. If they're not answered in the next couple of slides, I'll make sure I answer them. So, Verhaegh, close one day at 9 cents, open the next day at 10. So if you don't want to, if you're afraid of the day trading regulations, you buy them on a Thursday and then you sell them on a Friday. Right? Other than that, you can buy them on Friday and sell them on Friday. Here's another email from a student. He says, subject, my newest bestest buddy. Now, I don't know if he's referring to me as his newest bestest buddy, if he's referring to Verhaegh as his newest bestest buddy. My thoughts are you become friends with a stock. You get to know a stock. You hit that stock over and over, right? It becomes obvious to you when to trade it because you're so familiar with it, right? Obvious is a function of familiarity. Anyway, he writes on, wanted to let you know one of your students rang the bell with a really nice gain with SLB. Felt some shivers of greed hitting me, but felt like making a double was enough to put a smile on my face heading in the weekend. He bought the SLB 96.95 Strangle. Now, that is the 96 call and the 95 put, right? The Strangle, we always buy a lower strike price put than the call. He says about 1 o'clock yesterday. He said he purchased the calls for 50 cents and the puts at 58 cents. When our system is perfectly running, he would pay 54 and 54, right? We want them to be near equal to each other. He says he was able to sell the calls for $3.10 this morning and will let the puts expire worthless unless he makes money on those as well. He says, thanks for the effort and try and make me a slob. Again, he bought a pair for $1.08, paid 50 cents for one, 58 cents for the other. The one that he bought at 58 cents went to zero, right? People ask me, what's your success rate? And if I tell you 50%, some people are underimpressed, but hey, this 50% hit really good, right? Because he paid $1.08 for the pair, sold one of them for $3.10. I consider that a pretty good gain, right? Is it fantastic? Yeah, it could be fantastic. Is it short? Yeah, I think so. Different student, unedited email. I'd like to thank you for teaching me how to trade SLB. I've been trading it for almost 2 months with success. I'm up over $15,000 today. I basically trade with strangles and I'm amazed how consistent it works. I usually wait for the price to be between two strike prices, then I place the strangle. That's one of our rules. We have very set rules on when to enter. My question is, are there other securities that trade similar to SLB, or is this the only one with this unique feature? Thanks again. My question to him, my question to you is, would you need another one? Right? Would you need another one? Schlumberger, here's an option. Right? November this last year went from 2 cents to $1 late in the day. $2 became $100. That's a big move. Right? That's in a matter of minutes. Some of our moves are short-term, right? I show you all these really short-term moves. I want you to know that we don't only write about short-term moves. If you say to yourself, hey, I can't look on Thursday and Friday, I gotta look on Monday and then I gotta look, the following week or whatever. We have longer-term picks in our newsletter. Here's an example. This is an Apple option that moved from 17 cents at the low to 7.05 at the high. But it basically, for 3.5 days, you could have bought it under 50 cents. And, on Thursday, it got up to $2.50, gave some back. And on Friday, it was up, over 6 for quite a while. Speaking of Apple, I previously wrote in a newsletter, I've been writing newsletters for a long time, about a long-term Apple option. And I said, buy the option that's closest to $3. I don't care if you buy 1 month, 2 months, 3, 4 months in the future. I don't care if you buy a 1 or 2 year old leap. Buy the option that's about $3, right? And you can see here that option, right? I wrote about it on a Saturday. This is the movement on a Monday, and those options were up about 1/3. Right? But the reason I told you to buy long-term ones is because I was expecting a longer-term move in Apple. These options move from roughly $3 to 20 some odd dollars. $300 a contract to 2,000 plus per contract. The Pulse system, books and videos. I get into the specifics on how I pick stocks, how you can pick the same stocks. Right? I write a newsletter. Comes out every Saturday. Actually, I promise it by Sunday, but in 4 or 5 years of doing it, I think I've only published on Sunday twice. I tend to publish on Saturday sometime. That way I can have the part of the weekend off to myself. We have the watch list. We list the stocks which I feel have the best math, and we look back at a move from the previous week. Quite often those moves that we look back are from students that hit, right? I like publishing unedited emails from students as teaching tools, right? I like to teach. I have my top 5 plus or minus sections, which is the stocks that I pick, and commentary on why I'm picking them, and more specific instructions on when might be the best time to buy, and what to buy and what to pay. We always review the previous week pick, and we're constantly educating. Now, what we do here, and we're going to give you an opportunity to become a student, right? I'm going to go through this fairly quickly, and then I'm going to answer all the questions, right? So again, you can get my book, you can get some videos, you can get a subscription to the newsletter, constant education, and then a bonus video. Now, a couple of things. Sometimes I trip over my tongue, right? A trip to me is when I have a trick. I've been doing this a long time, so I have tricks to trading, and I have tips. And when I combine a trick and a tip, it becomes a trip. Now, I filmed for a different publisher a video called Polarity Trading. And the publisher that I filmed it for has left the business of selling physical DVDs. He wants to do just downloads. So he offered for sale to all his authors the right to buy the physical inventory. So the publisher of this newsletter, I do not self-publish. Everybody, I am a professional writer. I have press credentials. I have written travel articles. I've written a whole bunch of stuff. I am a writer, right? I'm a writer that trades, or I'm a trader that writes, either way. But this particular video, I think, is awesome. That video, that publisher, you can go out and buy it, a download for $149, right? But if you want the physical video, we'll give it to you for free if you become a student, and becoming a student is just a $97 subscription. Now, $97 gets you a 3-month subscription. A couple of things. I never discount, right? There is no, this is not a special. The only thing special here is you're getting that free video, which I think is a really good deal because people bought it for $149. I never discount, and I never raise the price. In that, if you subscribe, you can automatically renew every 3 months at the $97. It's not $97 for the first 3 months and then $397 for the next 3 months, or so and so. I do plan on raising the price, but you get grandfathered in. Again, I never discount, and it's not a loss leader price. It's $97, become my student, get the book, right? Get the video, get the bonus video. Now, the reason to join is how much do you use? Again, FCX options under a dime. That's a specialty of ours. That's $10 a contract. We regularly have them go 3, 4, 5, 6, 700, 800%, right? $10 becomes 80 bucks. How much could you lose? Well, I guess if you just read my newsletter and you paper trade, you can't lose anything, right? How can you not lose anything? Because we have a full money back guarantee. Now, our guarantee is that you can double your money 20 times in 20 days. And I gotta make sure everybody understands. I'm not saying you take $100 and turn it into 200. Take the 200 and turn it into 400. Take the 400, turn it into 800. Turn the 800 into 1600. Turn the 1600 into 3200, into 6400, into 12,800, and so on. Right? You're not gonna go from $100 to a millionaire in 3 weeks. What I'm saying is that if I can't show you, right, if you can't buy something for 100 and sell it for 200, buy a different option for 50 and sell it for 100, buy another option for 75 and sell it for 150, right? Buy an option for 400 and sell it for 800. If you can't do that 20 times in 20 days, I'll give you your money back, right? And I'll give you your money back even if you can't do it because you didn't try. If you weren't comfortable enough, we'll just give you your money back. So how much do you use? Right? In trading, we're looking as low as $5 or $10, right? How much could you lose being my student? Nothing. Having said that, I'm assuming that this is a link that people can click on right now. I am going to try and answer some of the questions that were asked. So bear with me. All right, first of all, I'm getting some people that have become a student. Thank you for becoming a student. I got a couple of people that are already students. Thank you. I asked to be interested in seeing years of results. To me, first off, I think I've made about $30,000 this year, and I might be exaggerating. It might be only 20, 25,000. And what is this, February 5th? So I'm doing okay running my system, right? I'm doing okay as a trader. It's not what I do that matters. It's what my students do that matters, right? Because if you become my student, you're not going to have my experience overnight. It's more important for you to look at other students, right? You got it, one of the emails. I've been a student for 3 or 4 months, right? I'm up, made $1,000 here. A student made 15,000. It's more their results than my results. So got a guy here, he says he bought the Tesla 230 calls today at 17 and sold at 52, right? Again, some people might not think it's fantastic because 17 bucks is a lot of money. Said, do you use a screener to ID candidates to trade options with? I have a formula that I've written, I put in an Excel spreadsheet. I'm more than happy to give to my students, and they can do it if they want to do it. Someone says, are these trades always done in a day? Again, I think I answered that a few slides later. We have some that we can be in weeks or months at a time. We try and give you the exit strategy when we give you the entrance strategy. Someone says, is this rule in Canada as well? I think they're referring to the day trading rule. I don't think Canada has that rule. And I guess somebody answered that. Someone says, and then but you can't do spreads in a cash account. I'm not doing spreads here. I'm buying a call and I'm selling the call later for a profit, right? I'm buying a put and I'm selling it. And if a person wants to do spreads, you would need to do that in a margin account. I guess guy here says, thanks for the webinar. I'm already a subscriber, still paper trading. Again, I think that's great advice. Dan wrote the FCX 19 calls today moved from 6 cents to 66 cents. That's what I'm talking about, right? That is what I'm talking about. Again, it works. How many trades in a week? Plus or 5 plus or minus. I mean, I've had weeks where I've written about one. I said, hey, look, no offense, this is the only one I see, and I'm staking my reputation on it. I'm not going to throw out a dozen just for the sake of throwing out a dozen. We generally have about 5 or 6 each week. Someone says they have no experience with stocks. Is that a problem? I think you're I think you have a distinct advantage in that, or maybe it's not an advantage, but you don't have a disadvantage because we teach you to trade options. Now, I realize I'm getting close to running out of time. Got a student that, let's see, Do you actually recommend the trade? In the newsletter, in the top 5, I give pretty specifics. All right. How do you avoid the ravages of time decay? That's a great question. Understand, we buy options when there's very little time left, and therefore there's very little time value, right? How much time decay is there on an FCX option that cost a dime? I would say a dime. and the ravages of losing 10 bucks, you know, we don't avoid that. You know, we run the risk of losing 10 bucks. It's just we have a statistical advantage. And again, we often will buy and sell an option that will end up expiring worthless, right? I've heard people say 85% of options expire worthless. No, I think 50% of options expire worthless, either the calls or the puts. We're not buying them to hold the expiration. We're buying them to sell at a profit.
We're getting close to running out of time here. So, Chris, first, this is Cam White with Trading Pub. I owe you an apology. Just when the session started, my Omnovia froze on me, and I had to exit the whole thing and get back in. By the time I was back online, you'd already taken off. So, my apologies. Can you hear me okay?
I hear you fine, Cam.
Okay, great.
I was wondering,
hey,
I was wondering why it wasn't being introduced.
And yeah, I know. And I was sitting back there, and I was going, "Hey, come on, my mouse, the Omnovia wouldn't even let me activate the microphone, so I had to bail and get back in. And by the time I got back in, you were off to the races." But I just wanted to thank you for coming back to the Trading Pub, and it was a great presentation on the Pulse system. What I like personally about it is that you have a system that manages to distill all of the stocks with weekly options down to that handful that meet your criteria in the Pulse system. And to be able to have a newsletter that not only gives you the trades that you're recommending for the week coming up, but also reviews last week's trades, I think is incredibly valuable, because I personally like to take a look at the history of my trades so I can learn going forward. And you know, finally, I'd like to thank you for your generous offer. I think $97 for 3 months of access to your service is incredible, along with the free bonus video. And you know, this is singing to you, and you're new to options or you trade options. I think it's a great service. So, Chris, I just wanted to thank you for coming back to the Trading Pub, and thank you for an excellent presentation.
Well, Cam, thanks for having me, and thanks for telling me what happened there at the beginning. I appreciate it. You know, I some of the people that are here will be curious and become a student. Again, I remind them, if after 20 days, you know, you haven't made 20 times your money, or you don't feel comfortable that you will be able to make 20 times your money, we'll give you your money back. It's, you know, pretty simple. I get people that, you know, look at it and see. I think if you read my newsletter, it's roughly 20 pages, you know, 15, 21, 15, 16, 18 pages. It is whatever it is. I mean, there's graphics involved. I think it's an easy read, because again, I am a professional writer. I think you'll
have access to your services for what really boils down to $32 a month with a money back guarantee. I think it's incredible.
Yeah, the bottom line, you know, I have students that make thousands and tens of thousands of dollars over and over again, you know, and you know, there's the beauty of an option. You know, how much do you use, and how much could you lose? You know, we try to do a risk reversal with our money back guarantee, and again, I've been doing this a long time, and I apologize if I didn't answer, you know, the questions, all your questions. Again, you know, running out a little bit out of time, running out a little bit of voice here, but you know, I think I do a good job. I want to thank each and every one of you for being on the webinar today.
There's some
whether
questions
you're listening live or listening to
Is there a telephone number where people can contact you?
You know, just have someone email you or whatever. I don't market at all, and so you know, my publisher set me up to be here and present, and he's got a phone number, and I've got it. I gotta dig it out of a box or whatnot, and so I would say have them contact you, and then you can. There, Jana's put up an email to contact, and then they can forward it or however. So, Cam, I'm gonna let you go. I'm gonna let everybody go. Again, I want to thank them for their time, whether they were listening live or whether they're listening to a recording. This stuff works. It'll work with you. It'll work without you. And you know, I just soon pick you up as a student. And you know, thank you very much for the opportunity to present. Thank you. God bless. And we'll talk to you later.
Thank you, Chris.